Welcome back to Galaxy Grid. I'm Alex Thorne. I'm joined this week by Thaddeus Pinikavich, Zach Picorni, and Lucas Chayan from Galaxy Research. We have a great show for you today. A lot of interesting news happening in the world. We're going to talk about the crypto market structure bill. It's coming to a head. Things are getting wild and getting into overdrive in Washington. We expect a lot more information this week with a key hearing on Thursday. We'll talk about what that means, what is at stake, and what is likely to happen under different scenarios. We'll also talk about new exciting drama in prediction markets. Surprise, surprise. In this case, we're going to use the markets around Venezuela that sort of revolved around the capture and arrest of Venezuelan President Nicolas Maduro. There were some interesting questions related to bets that were made, but even more so the resolution logic for some of those markets and whether they were satisfied the way the market had expected. We'll also talk about MSCI punting on their decision on whether or not to exclude digital asset treasury companies like Strategy from their indices and punting until May. Very interesting question about passive investing in non-operating companies and what the impact of MSCI really would be if they were to exclude these. And finally, we'll talk about changes happening on X, Twitter, formerly known as Twitter. A lot of controversy about the state of the algorithm on the For You page. Is it deboosting crypto Twitter? Been an enormous amount of conversation on X about that. And by the way, none of the conversations about whether crypto Twitter being deboosted have been deboosted as far as I could see. My entire algo was filled with those conversations. But even more interesting, we'll talk about their launch of Cashtags. I guess you're going to be able to link to a specific crypto, even perhaps a specific smart contract. We'll explain what that is and what the impact might be. Before we get to any of that, I need to remind you to please refer to the link to the disclaimer in the show notes and note that none of the information in this show constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Well, gentlemen, we're back, and now it's getting exciting. I feel like we've been sort of scraping the bottom here looking for interesting stories. Actually, last week we had a great episode as well, but the beginning of the year, the end of last year, the beginning of this year, been a little bit slow. I would venture to say not slow anymore. Like, what's the vibe out here right now this morning on, January 12th, 2026, the year of the horse?
It's hard to keep up with everything. I mean, I don't know. My head's spinning around with what news items to pay attention to the most. It's global macro, microstructure. It's everything top to bottom here. It's going to be a nice volatile year for sure. The traders love volatility, so it should be an interesting one.
Yeah, I checked the calendar this morning on the way into the office and noticed it was only January 12th, but it has felt like we've lived several months this year already. We've had Venezuelan president captured, market structure, go down the line.
Oh, the Fed, too, the whole thing.
Oh, yeah, the Fed stuff.
Last night.
Is a big one.
Yeah.
Crazy. We'll see what happens. Let's kick it off with market structure. This is the second half of the two big issues in Congress that crypto had on its agenda, right? The first being a stablecoin bill, which we got signed into law in July of last year, the Genius Act, which creates a federal framework for issuing stablecoins that are, fully supported by legal and regulatory structure in the U.S. So formally legalizing stablecoins if they adhere to certain things like collateral management and whatnot. We got that we got, but that's not really a crypto bill. That's more of a dollar and payments bill. The other half, the other big item is the crypto bill. And the initial, we call it the crypto market structure bill because the initial main question was, what is a security? What is a commodity? Which type of token is regulated by which market regulator in the U.S., when, and how? And that is the question about market structure, right? What is a security? What is a commodity? What does the SEC oversee? What does the CFTC oversee? That's sort of become table stakes now because I described this in our newsletter last Friday as sort of, it's turned into a Christmas tree bill. Everyone's trying to hang on new ornaments, right? This is really just a crypto bill now. It's everything outstanding that stakeholders, whether supporters or critics of crypto, want addressed in the crypto market. So it still has that security commodity stuff in it, but most of that is not what's controversial and is not what has become major sticking negotiating points. Instead, issues like how to handle illicit finance, if, how, and when, or if at all, DeFi apps should have to register as some form of business and be regulated or conduct KYC and AML compliance, how to handle government ethics questions, late additions now in these negotiations, I'm told over the weekend, whether prediction markets should be banned from supporting bets on sporting outcomes. Also, whether or not DeFi tokenized securities should be allowed to trade into DeFi without formal rulemaking. A whole laundry list of, and crucially, also, I should add, trying to maybe retrade a little bit on the yield-bearing provisions of the Genius Act. Should stablecoin issuers be able to, in some form or another, pass yield down to their token holders that they earn on their underlying collateral? All of these issues, most of the ones that are sort of causing, that are at the tip of the spear in these negotiations between Republicans and Democrats in the U.S. Senate, not related fundamentally to the concept of market structure anymore. So that's why I say it's sort of just a catch-all crypto bill. Let's wrap it all up. But a key hearing in the Senate Banking Committee scheduled to happen on Thursday morning, January 15th, so just a few days from now, where they will mark up a draft, which means that the members of that committee will ultimately vote on moving language for that bill from the committee to the floor of the Senate, where it would ultimately be voted. Crucially, also, the Senate Agriculture Committee will also hold a markup, we're told, although that isn't totally confirmed yet, also on Thursday, which, because I mentioned, the bill also involves the CFTC and commodities, which are overseen by that committee, ultimately will be crucial that both hearings happen. But I think we're sort of monitoring the Senate Banking Committee as the most important one. That will be on Thursday. So I'll stop there. But that's the news item.
So which battle lines are moving the most here? I mean, are we got some things that are solidified more than others that this is pretty much agreed on? We're the new kind of, axes of contention now. Like what's really, what are the sticking points left?
Yeah, I mean, some of the ones that crypto cares about the most, I would say. There are several I mentioned. Yield and DeFi, or DeFi/illicit finance, in my view, are the most important that the industry is grappling with. Well, I think we all agree that to be competitive, a stablecoin issuer should be able to pass some yield down. And, and that's true. That would be a fundamentally better product. And there was a story that China is going to let their CBDC holders receive yield on their stable. So there could be an international competition angle, and I think as Americans, we all want the dollar and the dollar instruments to be strong. I don't think from a crypto industry standpoint, in my view, it's as important as illicit activity in DeFi. When I say that, I mean not extending Bank Secrecy Act compliance reporting obligations to entity types or developers of software who fundamentally can't comply with them, right? Like if I make a non-custodial wallet and release it on GitHub, surely I can't comply with that. We want to enshrine those protections and safe harbors for truly decentralized non-custodial technologies or their developers in federal law. No one's saying that if you're a business that holds crypto accounts for clients whom that you wouldn't be a financial services company, right, or a money transmitter. That to me is the most crucial. Like that's like if we don't get that's a red line for crypto, right? Like because it's good for policy. It encourages the creation of decentralized technologies, which are, as we've talked about, less risky in a lot of ways, right? Because there is no party that can rug you. That's sort of the two most important, I think. But like I said, Thad, like in the late in the 11th hour, some insertions to this debate have been happening. When you have a moving vehicle in Congress, meaning like a legislative package that looks like it's making progress and might get voted on, people try to hang all sorts of stuff on it. So, and this is such a broad issue, as people who like crypto know, like crypto blockchains cover like such a wide variety of possible things that there's a whole bunch of stuff. I mean, right, like the gaming industry wants to brick prediction markets, right? Or at least I would say the main source of their current revenue they want to brick, which follows off that discussion we had a couple of weeks ago about all the lawsuits related to that question. They want to tip the scales in those lawsuits in their favor, and I don't know, they might get that. It's just not clear. There's a lot of moving pieces.
Yeah, what is the risk of this thing turning into a Christmas tree? That like in your words, a Christmas tree, like to getting what we want. Like if people are trying to attach so many different things to it, like you kind of lose the narrow scope that it felt like we had with the stablecoin legislation. So like, do you see that kind of being a barrier to getting what we want?
I think incredibly likely that this becomes an extremely comprehensive bill. And part of the problem with that is, in order to, if you have 2 or 3 constituencies, like, it's easier to reach a negotiation, right? You have fewer, if you just think of it like a puzzle, right? Like, you don't have to give as many people as many things to get the other people to join. But when you have, 30 issues, right? Now you've got, it multiplies exponentially, and you really don't quite know. And you could end up with, I mean, either side of whether you're, you want more restrictive policy for crypto in the US or more permissive, either could just end up with like a decent bill on the floor, but that happens to give away like one of the really big things to the other side. You just don't know. Like, there's so many moving pieces. We don't quite know, I would say. And I would say, look, we are expecting this is going to come out tomorrow. So for us, so it'll come out on Tuesday. So if you're watching this, the Senate Banking Committee will have already released their latest discussion draft Monday night on the 12th. And then senators have to deliver text of their proposed amendments to that draft by 5 p.m. on Tuesday, literally electronically, and then physically with a wet signature from the senator and 50 copies physically delivered to the chair of the Senate Banking Committee's office by 5 p.m. on Tuesday. So again, maybe we'll get more details Tuesday night, and then there'll be negotiations about which of the amendments to vote on. Like, we don't know, but I would say, Zach, like, in terms of whether this becomes a giant, like, hugely comprehensive Christmas tree, extremely likely. Who the winners and losers are in terms of which ornaments get to stay on that tree, super influx. We really won't know till the last minute.
What are the risks of it not passing now? Like, is it better that this kind of just stays in a debate mode and moves on to maybe because I think in the piece you talk about how if it doesn't go now, it's probably going to be at least another year before we see real progress on this.
Yeah, this is, I think, the key question for markets, right? Like, what are the scenarios and possible probabilities of them? And without giving like huge, concreteness on the probabilities of each scenario, since they're changing pretty rapidly, those probabilities, I would say the risk generally fundamentally for crypto isn't that high if nothing gets done. I think the risk is much higher, although not necessarily the likelihood that something bad gets done. That would be worse. So anything that gets codified into federal law that's bad would be a lot worse, I think, than nothing happening at all. And part of that's because the industry is getting a lot of what they want through administrative relief and regulatory pivots and guidance, right? Like, nothing happening at all, at least for the next couple years, while we have, more progressive thinking regulators in the seats at the OCC, the FDIC, the SEC, the CFTC, right? Like, would be okay fundamentally for crypto. I think the main reason that, crypto advocates want something passed is, I would say, 2 main reasons. One, to protect from the risk of rollback in the case of a very hostile administration, similar to the way, Gensler's posture to crypto has been largely rolled back by this SEC. Like, that could happen in the other direction. So you'd want it codified in federal law, right, which is much more durable than just regulatory interpretation of law. And the other one is like, it's like I called it the last final leg of clarity. Like, sure, this will make it much more, make it both traditional or any types of businesses much more confident to enter crypto than they otherwise would be relying solely on regulatory guidance. And then lastly, I'll say on this, since this is a long one, the probabilities of outcomes. You've got an outcome, the best case scenario for the Senate banking hearing, but also, the ag hearing in general, is a bipartisan advancement out of the committee onto the floor. And in the Senate Banking Committee, that looks like all the Republicans voting yes and 2 to 4 Democrats on the committee also voting yes to move it out of the committee. That's what you got during Genius. You got 4 Democrats, right? And 4 Democrats on Senate banking voting yes ultimately yielded 68 votes yes on the floor, which is a veto-proof majority, right? So that's what you would want to see. I think a positive outcome could be perhaps just 2 Democrats, really, and not 4. The 4 key sort of possible yes votes on the Senate Democrat side in that committee are sort of split half between the illicit finance issue and the yield issue. So there's a scenario where you don't give on both and maybe you give on one. And so 2 of the Democrats vote yes and the other 2 vote no. That probably could still pass the House. The Senate, like on the floor, but it's unclear. It's certainly not certain. That outcome of a bipartisan success from the committee is probably somewhere in the 20 to 25% likelihood at this point as we record on Monday. There's also a scenario where none of the Democrats vote yes, but all of the Republicans vote yes. So a fully partisan successful markup. Republicans have enough votes in the committee to advance it by themselves. That probably does not pass the Senate floor, though, right? So put that at maybe 50% likely at this point that you get technically a successful vote, but not one that portends necessarily a positive outcome ultimately on the floor. Although more negotiations can occur, that even if like the Republicans advance it, then they could sort of promise the Democrats that some of their amendments would be added on the floor. But, and then probably the next scenario is a failed markup. It doesn't pass the committee. Not all the Republicans vote and not enough Democrats cross over. That's bad. That's pretty bad. But I would say there is a silver lining there, which is that you'd at least put all the senators in the committee on the record as to exactly why they were voting no. So then if you go back to try to renegotiate, it'd be harder for them to make new 11th hour demands, right? Because they'd be on the record for why they were for or against. So at least it would make some progress putting people on the record. In that case, though, like, it's the timelines, both congressional calendar, the midterms coming up, also just Congress and the Senate's and the Senate staff's like just patience with this issue. This has been a real slog, and with all these constituents getting involved, like this is tough for them to work on. Like they don't want to do this anymore. They want to get this done and move on. There's a real risk that if you have a failed markup, like you don't see any second effort be remotely successful in this Congress, meaning until like 2027. It is possible still that it could happen if people remember Ingenious, like in April and May, there was a chance of it going to the floor, and then there was some 11th hour demands by Democrats, and that delayed it ultimately a month and a half. And then there were several failed floor votes in the Senate, and yet it still did get done. So it is possible in the case of a failed markup that something could get done, but it becomes extremely less likely. And I don't know. So I said 20 to 25 versus 50. Maybe there's a 20 to 30% chance that they go forward with the vote and nothing moves out of the committee. So it's a pretty wide dispersion of possible outcomes. Anyway, I'll stop there. Look out for our content because I'm going to be writing about this a lot this week. But that was a nice thank you for indulging my policy wonkness for, according to the timer here on our recording, 21 minutes. Now let's get into some more interesting crypto stuff. And Zach, maybe you lead us off here and explain what happened. But the high level story was markets relating to Maduro, whether he would still be in office or whether the U.S. would invade Venezuela on Polymarket. There were some bets. There's always some bets that you see. A fresh wallet made like $200K, like betting that he'd be taken out or something. But the more interesting one you were saying in your piece here was that the market's resolved. It's an Oracle problem or question. Again, resolution, criterion dynamics were interesting here. What was the story, Zach?
Yeah, I mean, we got like both of the biggest critiques of prediction markets at the same time. Like historically, these have been like asynchronous things. It's like, oh, people bringing up like the question of insider trading, and then another weekend it's, oh, the definitions used to resolve these markets or the infrastructure used to resolve these markets is just suboptimal. But we got kind of both of them at the same time. And yeah, there was like insider trading questions around the like, will Maduro be ousted as the Venezuelan president before like X date. That one obviously resolved to yes, but people were kind of calling foul play, saying there might have been some insider trading, as like one user made like a few $100,000 off of a trade that they had put in maybe a few hours before the market resolved. But like we said in the story, like it's hard to use just purely on-chain data anecdotally to say like there's foul play here, like there's insider trading going on. Like it requires this more like multi-dimensional, like on-chain, off-chain analysis to actually confirm that insider trading was at play. And also I think just like on X or Twitter, like saying that insider trading in prediction markets is bad is just a thing that people are kind of flocking to. So I think people are kind of incentivized to talk a bit more about it. But the more interesting component of this is like the definitional nuance that's used to actually resolve the markets. Like, what is the question, or like, what is the definition of invasion in this market? And like, what is what do they actually use to resolve it?
Yeah, because what was the market? Like, what was the title of the market with the invasion question?
Yeah, it was, will the U.S. invade Venezuela by, and then like a list of dates. But the interesting thing is, in the actual market rules, the word invasion was never used. So like, there's like kind of a mismatch between the title and the actual definitions used to resolve the market, which we highlighted as like an issue that prediction markets could and should control. Like, Polymarket probably could have used a better word than invade, because most people just look at the titles of these markets and ignore like the 2-paragraph definition that actually resolves it. Because if you go look at the actual definition, it becomes more of like a land control question than like an actual invasion. Like, we just like move in, take you over, and leave. The actual like text that's used for the market rules is more of like does the U.S. military actually occupy like a piece of land for like some amount of time or whatever?
As they say, the devil's in the details in this. It's very reminiscent of what happens in TradFi as well too, when it comes to considerations of whether someone has defaulted or broken a covenant. Really getting into the nitty gritty of what the definitions are, what terms are, what the edge cases are. There are huge arguments between creditors over billion-dollar defaults or what they consider not defaults, based off of nuances of language and contracts. So it's a problem that exists not just in the prediction markets as well too, but one just generally that's pernicious across contended or contested outcomes. Is it an invasion? Is it a police action? Is it an enforcement action? The nuances, and then who really kind of makes the final say becomes a very important part of it. It's in the traditional landscape, it's usually lawyers and kind of dragged out in court. But we've got the court of UMA votes in predicted Polymarket's case.
Yeah, I mean, there's definitely been like more like egregious examples of this in the past. Like, the first one that comes to mind is like the will the U.S. government shut down market that they had, which like traders literally ran the price up to like 98% probability of yes, and then like they ended up resolving it to no. Like, I'm looking at the chart right now, like it only went to as high as like 35%, like, albeit that's like over a 10x increase over a pretty short amount of time. But like, you could clearly see that there was like somebody in the market who like understood what the actual definition of this thing was. It wasn't like it was just like an Instaport up to like 90-95% and then it sat there. It's like, as fast as it made it up to 30%, there was somebody like smashing sell, clearly. So like, I don't know, I think like the criticism of the definition or like the market rules feels a little forced in this case, at least using like past markets where this was an issue as kind of the baseline barometer. But yeah, I mean, just looking at the chart, like clearly somebody understood like what the definition was, and it wasn't just like the whole market was kind of tricked and then Polymarket like rugged in the end.
It does seem to have some corollaries to like what we see with on-chain trading and this whole debate of like when users trade through a like aggregator or DEX and they have high slippage set and then they get like sandwiched. And it's like, all right, well, is it the sandwicher's fault for like taking advantage of maybe a UX design issue on the front end where the user doesn't realize they're setting that slippage that enables that? Or is it the user's fault for not understanding that if they set that slippage, it opens them up to these types of exploits? And like, it does feel like a very simple fix here is just like much more prominently education first off on like the user part, so they understand what they're actually getting into, and then second off, just like UX design to make it much more prominent so that they can more easily understand like, all right, this is exactly how I will win and lose this.
Yeah, I mean, there's always going to be an element of like, you need to kind of take like self accountability, and like users are going to have to do their own due diligence to some extent. Like, Polymarket can't force you to read the market rules. Like we mentioned, they could do something like a terms of service style where like the first time you click into a market, like the rules pop up and you have to like scroll through it. But like even then, like think about what the average person does when they get hit with like a terms of service thing. They just scroll through it and then go. I think like just making the the events that these are around, like, as black and white and clear as possible, I think is important, like, not only for like market clarity and like giving people an easier ability to predict things, but just like so that we avoid this issue of like contentious resolutions. Even though we haven't had one in a while, it seems like, but I think it could be greatly mitigated by just saying like, will there be like U.S. military presence in Venezuela? Like that might have been a better way to do it. And it
Do you
gets to the
think?
same point. Like,
do you think it might push folks forward towards like Kalshi or folks that are more kind of a centralized resolution mechanism rather than one that's kind of relies on the market based one with UMA?
I mean, I don't think this is like a question of like on chain versus off chain. Like a prediction market, like in this sense, I think is just a prediction market. Like you still need to trust Kalshi to have proper titles, proper rules, and like sound resolution logic. Even though I feel like I haven't seen too many people complain about this from Kalshi, which I guess is kind of like an interesting observation. Maybe I just don't follow enough Kalshi people on Twitter, but yeah, I think this is just like there's no like prediction market that's immune from this. Like you need like humans to some
Aren't
extent.
there like a million Kalshi people with that badge on their name?
I mean, Polymarket does the same thing. It just became like a KOL war. But yeah, I don't think like any prediction market is immune from this problem.
Are there any prediction markets where they're creating kind of incentive to make the resolution more clear in terms of like, let's say you have the initial market that pops up and the phrasing of it doesn't seem as clear, and then somebody's like, well, why don't I just make one that I think does have a much more clear resolution and will attract much more volume, and maybe they get a percentage of like the trading fees that happens on that market or something like that? Is that a design mechanism that's been explored at all?
I have no idea. I feel like the response to this, like when it was like more of an issue, was like, we're just going to make the creation of markets like semi permissionless, where you like whitelist a bunch of people who can go do it. Like maybe like community notes for rules, but you also want to make like the market creation process and like the whole mechanism as simple as possible. Like I think you just need to just use clearer cut words and make sure the titles match the actual definition.
Not crypto Twitter's strength by far.
It never ceases to get interesting. And I would say too, like this thing about, we talked about how the sports event outcomes so important for these markets. Those are more binary and obvious, so less likely, I think, to have weird decision resolution mechanisms. But if that gets taken away, I don't know where they're going to innovate next. They're going to have to do something.
Impact markets are next.
So, and by the way, Zach has a great report out on galaxy.com/research about decision markets and impact markets. Let's move on here and talk about MSCI, the giant equity index provider. There was a big story over the last really like month and a half because they had I guess they have a quarterly rebalance meeting where they decide what will be included in their indices. And on the agenda to discuss was whether to exclude digital asset treasury companies, or even said better, companies who I think more than 50% of their balance sheet was a crypto asset. And of course, the main one that this would have affected was Strategy, MSTR. The MSCI said last week, I believe, that they were not going to decide on that issue. And instead, what were they going to do? So that was seen as a win for, DATs, but also even particular strategy holders. Thad, what was the story? What did they decide? And then let's talk about the impact of it.
Yeah, there's been a bit of a sort of Damocles hanging over the head of strategy holders for a while. They're worried about the forced selling because essentially what happens, these MSCI guys, formerly actually Morgan Stanley Capital International, if you want to know where the name comes from, but they create all the essentially indices that the metrics that trillions of passive index dollars are invested through. And they, in contemplating, were thinking of any company where more than 50% of the non-operating assets on the balance sheet were cryptocurrencies, that they would be excluded from the index. and kind of felt like a little bit of a knee-jerk reaction to the DAT formations that we had over the summer. Saw a lot of SPACs, a lot of companies just essentially being, housing cryptocurrency, and that being most of the business. But this past week, MSCI came out and they consulted the industry and took a step back and said, not focusing necessarily just on cryptocurrency companies, but looking more broadly at companies that had what they said, non-operating assets. And this is where it kind of becomes it becomes contentious, and this is where the passive index here comes a bit more of active decision making about what a company is. Because if you kind of expand the idea of like, okay, the issue they had with DATs, that they think they're not really companies, all they do is hold assets. And they drew that arbitrary line, and it was just about crypto. But there are plenty of other companies that may fall under this too. Gold miners. If gold miners have the majority of their assets just in the actual assets they pull out of the ground, they're not being used for productive uses. Should they be discluded just because they're simply mining gold? And the same thing applies for other, essentially any other asset you can think of as well too.
And any holding company,
intellectual
too, right?
property. Any holding company, essentially really taking this non-operating asset lever and considering whether, that should disqualify a firm from being part of these index because they consider it more of a investment vehicle, closer to, like a commodities ETF than an actual firm that has a business. But they pushed it back to next quarter for more deliberation, more industry feedback, because 50%, is that the right line? Is even considering the balance sheet composition of a company a viable lane to kind of look through and evaluate them from. There are plenty of firms where balance sheet strategies are a lot of what they do. I mean, a lot of hedge funds as well too, kind of just are a lot of balance sheet strategies trading around their assets. So it's a very interesting kind of question here about what's going to happen. So the one thing that we were concerned about is that if that actually does pass, there's a bevy of crypto DAT companies that could see a lot of essentially forced selling from index funds. There were some estimates out from, I believe it was Bitcoin for Corporations, that could have been $10 to $15 billion of potential outflows. And firms that include are, not only Strategy, but Mara Holdings, Hut 8, Metaplanet, even, folks like Bullish, which is more of an exchange. The preliminary list they put out the preliminary list they put out was over was almost 50 companies. So it would be a quite a large event. But we've got some time now. They've, I wouldn't say this is truly a win for crypto. The can has been kicked down the road. I think this is still a question that they're going to, come to some sort of resolution on, that is going to be discluding some firms from indices, but where that line is drawn and kind of the nuances of that argument are yet to kind of be really fleshed out in public.
Interesting. And it was taken as a big win for, by particularly strategy holders, who obviously would be, I think, have the most to lose of any, because it's the biggest. I don't know. Do we have any sense on what the odds are that, expanding the scope of the question to just generally non-operating companies is a gambit by MSCI? So, because you could imagine that they say, well, any company that, holds more than 65% of their balance sheet in one asset will be discluded. And then in reality, that ends up being almost like all the DATs and not really anyone else. And they get to sort of kick DATs out without being blamed for it. Any thought? It seems like a conspiracy theory, but that does seem like it could still happen.
I think it could. They also definitely just, brought in a lot more firms, a lot more capital that are committed to staying in these indices as well too. So the fight is going to be fought harder for more folks, not only just crypto people. So there's still a risk there. But I think the signaling from this pushback is that they do not want to focus just on crypto, and they want to make a more kind of broadly principled rule, which is fair, which is what you like to see, but still may end up on the negative end of some action there on the crypto side. But I'd give it kind of a flip of the coin here on where it really lands. There hasn't been too much kind of a public response from folks other than like strategy and main dApps. But I'm sure now with this change, we'll see some response from other traditional companies that are going to be affected. I think, like I said, gold miners, IP holding companies, and the like.
Well, the most relevant poly market for this, which was like, will MicroStrategy be delisted from MSCI by March 31st, was at like 75% until this announcement came out, which is, I mean, there was about 500,000 volume, so not massive volume on it, but definitely interesting. And a new one is not spun up yet, so it'll be interesting to see what comes up there. But until then, maybe the nothing ever happens poly market from MicroStrategy is a better proxy, which is just saying that nothing will happen. MicroStrategy will not sell any Bitcoin. They will announce holdings of 750K Bitcoin. They will not announce bankruptcy, and they will not get added to the S&P 500.
Wait, so they really are mostly nothing happens markets?
Yeah, it's literally just nothing ever happens.
For a year with so much happening, the winning trading strategy is to bet nothing happens.
Hey, Thad, when is the next MSCI meeting? It's in May or something, right?
Yes, I believe it's in May. So they have the next announcement should be in May. I believe the open comment period is in through February here. I can get the exact details, but yeah, we've got another quarter until we hear it.
Kick the can.
Save
and
the debts.
So maybe the new poly market should be, will it be delisted by May 31st, basically, or something like that? Yeah.
Yeah. And if you're a shareholder of any of the respective companies, write in with your support for
yeah, there's a comment period. I think that's right. I think and pay attention. All right, let's move on. Our fourth story, Lucas, give us the TLDR here. Lots of drama on crypto Twitter about whether the X algo is deboosting systematically crypto-related content. Nikita Beer, the head of product at X, has been the primary recipient of the ire of crypto. Give us the TLDR on that. But also, there was a big crypto-related announcement from X as well relating to Cashtags. Tell us what that was.
Yeah, definitely. So yeah, two big kind of developments over the past week. The first one, is, crypto Twitter has been giving Twitter, especially Nikita, a lot of flack over the past few months, basically saying that like the crypto community is like being prevented from getting their voice out, and crypto tweets are getting kind of like either blocked or like hidden from others. To which like there hasn't really been a huge response from Twitter until kind of Nikita came out last week. And basically like what he said was, he was like, well, don't reply GM under every single tweet, because that just like basically turns it into a spam. And that's what crypto Twitter is especially good at. That's where they excel. But also kind of he did actually, I think he actually deleted the tweet afterwards, but he did kind of leak some alpha in terms of how the algorithm works, and that there's actually like limits to kind of how much you can get a reach. And when you hit those limits, your tweets stop kind of getting the type of attention you might think. But then in a surprising development, Elon Musk came out and basically said, hey, we're actually going to open source the algorithm for X, and you're going to be able to see exactly how people, how tweets kind of get attention, are promoted. That should be coming, I think he said, in the next 7 days. So that would be very interesting to watch play out, because first off, like, anytime once people know what the algorithm is, like, there's going to be so much gaming that happens, and especially on crypto Twitter, where like there's a direct incentive to really try and game these things to get as much attention, so it helps your coin's price action. Like, I'm sure there's going to be a slew of solutions that immediately emerge, and I'm interested to see how the algorithm changes immediately afterwards. He did say that they would be updating it pretty frequently. But then the other, I think, really interesting announcements was, yes, this smart cash tags that Twitter is going to be releasing, which basically means, right now you can post a ticker on Twitter, and if you click that ticker, it'll basically take you to a list of kind of like all of the tweets about that, and you can do it by latest, or you can use the smart algorithm to filter it. But what they're actually going to do is they're going to shift to a model where when you click a ticker, it will take you to basically like a dedicated ticker page that not only shows like all the relevant tweets and information about it, but also has a price chart on it. And he didn't explicitly say this, but in the image, the sample image they shared, there was also a buy sell button. So, I think it's very possible that in the future we see direct integrations for buys and sells. And what was really exciting here for crypto was, one, in the announcement, he specifically called out smart contracts. So I would say this is like the second time we've seen a big company make a new product release that features crypto specifically. Google with the X402 announcement that they made previously, which we talked about. And second off, he, in the sample image, featured cryptocurrencies themselves. So he featured a very prominent meme coin on Solana. Nikita is actually an advisor to the Solana Foundation. So there's been a lot of speculation about kind of like how him being with Twitter and Solana might help advance Solana specifically. And it also featured the base token, which is not released yet. But based on that image, will be trading at a 373 billion market cap and would make it the second biggest cryptocurrency.
To be clear, like
Bitcoin.
This is a UX mock-up that was shared, and it is interesting. Base token hasn't even been announced, merely wondered about, right?
Exactly, just hinted at, yes.
Yeah, very interesting though. The buy sell, like, is this by the way, actually, before I get to that question, is this just cryptos or is it stocks as well?
No, stocks as well. Definitely stocks as well. They've got Berkshire Hathaway as one of the stocks on there, and they've also got gold, so commodities also.
So so the UX mock-up showed Berkshire, gold, a meme coin, and an unannounced L2 token.
Yes. They're really hitting all the target audiences.
That's gonna be trolling, right?
Yeah.
This could be great too for also helping prevent some fraud stuff. I mean, there's a lot of third party applications to help prevent folks from buying duped tickers of folks that are just trying to steal some folks' money. So having some true social verification, community notes on proper contracts and stuff can help save a lot of people from a lot of pain from fraudsters as well too. So it's interesting. I like it.
Yeah, I mean,
there's like two funny things about this. Like, one, they're literally open sourcing the Twitter algorithm at like the crypto Twitter peak of vibe coding. So like, who knows like what people are going to be building off of this. I think it's going to be pretty funny. You're going to see a lot of vibe coded apps on like gaming the Twitter algorithm, but also just like looking at, I mean, we don't have like much of any details about this at all, but just kind of like looking at their mock-up and kind of what you ran through, Lucas, like the diverging approach of like what they're doing in terms of like SocialFi versus like if you go to like the base app through Coinbase, where it's like everything token, the messages are tokens, the pictures are like NFTs and stuff. Like, this is more of like, here's a social element, people talking about this asset, and then like, here, go buy it. Not like, I'm going to try to become a creator and turn all of my tweets into tokens. So like, I think the divergence between like what Twitter, like a massive social network with a ton of traction, is doing versus like what we've been trying to do like natively in crypto for the last like, who knows, like what, like 5-7 years. Like, I think like the Twitter approach seems a lot more functional and much more reasonable than everybody just turning their tweets into tokens and us having hundreds of millions to billions of these things over time.
I do think buy sell is also a huge question. Information about them alone, I think, would be very impactful to both of your points about preventing fraud and ensuring that users of X see true information about the coins or stocks that they're clicking and not dupes or frauds, right? I think there's huge demand and need for that. That alone is a great feature. I think that would be huge, and it would also promote the growth of communities around assets on X. But the fact that the mock-up had buy sell, this is like the super app question, right? Elon has talked about this, wanting to emulate some of the apps out of Asia that have everything: payments, chat, social, right? Like, and by the way, the SEC separately has been using the term super app in some of its things and is sort of generally supportive of the idea that like a broker dealer, for example, would be able to let its clients facilitate for its clients trading in both equities, but maybe commodities and crypto. So like that UX mock-up though, kind of a troll, like kind of interesting, like a lot of info or hinted at or implied information in that mock-up. Very interesting.
Definitely, right? Yeah, definitely. Like I think it's getting people very excited at a time when people have been very down on Twitter. And the other thing that's notable on Twitter is they just doubled payouts for creators as well. So like they are pursuing a very aggressive push, it seems like, to get people back interested in making Twitter their primary platform. There's been hints about using Twitter as like a payments platform as well. We haven't seen that really materialize yet, but I think that's possible in the future. And ultimately, like, I think this really ties back to what we were talking about last week, like Zach was mentioning, like, the Twitter approach here is like, let's not tokenize content. Let's use social media to make it more fun to trade tokens. And that's really where SocialFi, I think, can excel and do well. And then when it comes to the open sourcing of the algorithm, like, once it becomes open source, does that mean that maybe they say, all right, listen, since this is no longer like a proprietary thing, it might be better for our users if they can like take this algorithm, modify it how they want, and implement their own ones, And so the Twitter super app thesis, I think, is definitely starting to come to light. And for crypto, it is I think it's existential, because it is really like one of the most important applications in terms of how information is disseminated in the crypto community. And the success of Twitter, I think, directly helps amplify the success of crypto.
Yeah, on the gaming thing, I think they mentioned that they're gonna like republish it like once a month or like once a week. So like it'll be published and then changes to the code are made, and then you don't actually know what was changed until like a week or a month after. I forget what it was. But it would be kind of interesting if they made it like modular and they let you create your own algorithm for the content you see and plug it in.
Because you can make lists right now to create your own feeds, but if you could load code into the list to make your own algorithmic feed, that is also quite interesting. And by the way, I should point out, like, is crypto being deboosted at all? I don't know, but I joked at the top of the show that I've seen an enormous amount of content about crypto Twitter being deboosted. Like, those contents, as far as I can tell, have not been deboosted. And then the other one is, is it being deboosted, or is crypto Twitter down? I mean, enormous. We're not at the peak of retail crypto mania. Like, it's reasonable to think that actually crypto content is down. I saw another post about how crypto YouTube views are down. I don't even, if you've waded deep into the cesspool of crypto YouTube, like, that's a whole different thing. But apparently views are down there too. So maybe some of this is cyclical or related to markets. And I was going to say one final thing. Although I'm not saying maybe there aren't issues to fix with the algos on Twitter, but you can go to the following tab and see only content from your followers, and they've added both a choice of recent or popular in the following tab. So part of me thinks a lot of this is blown out of proportion by the crypto Twitter community, that actually they've added tools to see more from people you follow versus just the For You page. And the For You page is sensitive to what you click. If you're seeing, too much like racing videos, then it's probably because you liked them or watched them, So I think some of this is overblown. And by the way, directing it at Nikita in particular, he has said that the algorithms on Twitter are written by XAI. He's in charge of the core product, not the algo design specifically. That's what he said. I don't know. But I think all of these are interesting developments with the cash tags and the potential for a super app. And then I would love that idea of open sourcing and letting you modify. Very interesting. And I think, Zach, by the way, to your point, they're not going to develop the algos in an open source manner. They're going to release the source code for viewing, they say. So it's not like they're asking the community to help design the algo. They're saying, we'll let you know what it is. I do worry about, what's the first thing everyone's going to do, right, when they release that code? Instantly
Claude
dump the entire code into Claude or even ChatGPT and say, explain how I can write a good tweet. Bangers, right? Like, brought to you by Claude.
I don't know. This was like the ultimate, like, guy with $20 has a question for the dev. Like, we literally got Twitter to open source their entire algorithm. I think it's pretty sweet.
Well, like Nikita just like responded to the people saying like that crypto Twitter is being like muted or whatever, with like all these stats showing how engagement is way up since he joined. And then the classic crypto Twitter response is just like, they're farming us. Like, we're being farmed now by Twitter, and it's just like, they can never be happy,
All right, let's talk about the week ahead. I'll start, but what is everyone following in particular this week? Two major things, won't be a surprise. One, the crypto market structure bill, which we'll have lots of updates on this week because it's a very big consequential week for crypto in Congress. I'll be following that. And then two, which we haven't talked about, and I don't want to open the whole can of worms now, but this report that the DOJ has sent grand jury subpoenas to the Federal Reserve as it relates to the Fed's own renovation project of its historic buildings. Fed Chair Jay Powell came out on Sunday night with a video saying that those subpoenas were a pretext for the administration to pressure the Fed on monetary policy. Not only us, everyone will be watching any developments there. And one thing I'll note, by the way,
Greenspan, Yellen, and Bernanke all also put out a letter in support of
Jay
Powell this morning as well.
Yeah,
so.
and we've talked about this. Let's not go into depth now, but Jay, I think a pretty competent Fed chair insofar as they go. Very reasonable to be critical of the Federal Reserve broadly, obviously, but in the seat as it exists with the job, I think the man has tried hard to be pretty impartial and academic as opposed to partisan and political. And one other thing I just want to point out, I've always wondered to me about this government's complaints. Don't get me wrong. I want to root out fraud and abuse just like the next guy, but the Fed pays for its own renovations. The Fed is not getting money from Congress to build this stuff. The Fed has money. Shouldn't be a surprise. The Fed creates money. They got all the money. So I wonder what the legal basis for criticizing the Fed's spending of its own funds is. It's not like these are the taxpayers' funds. But anyway, we'll be watching that as well. Thaddeus, what are you watching this week?
Watching this week, mostly football. But
let's go. Pats had a great win Sunday night.
Pats had a good win.
Sorry, Lucas is a Jags fan. I know
it's all right.
That was a good game though.
But no. Along the lines of some of these contentious prediction market stuff and some of the work that Zach has been doing a dive into opinion markets, things that don't necessarily ever end. Is the banana taped to the wall of actually art or not? Things that aren't necessarily black and white decisions, and where you can kind of get a little bit of market clarity there. Yes, absolutely.
I'll be looking at there's some life back in the Solana trenches, is what I'll say. And we've seen DEX volume start to pop up a little bit. We've seen, I think, a surge in terms of not just traditional meme coins, but also some of these creator coins that we were talking about last week. And this is all happening a week before the 2-year anniversary of Pump.Fun, which is January 19th. Pump.Fun also announced quite a few or some updates in terms of how they're doing their fees and things to better support people that use the platform. So I think there's definitely some speculation about maybe something coming up on January 19th. What does that mean for Pump.Fun? What does it mean for users on Solana? What does it mean for the meme coin ecosystem as a whole?
Yeah, and I'll be watching what comes out of the newly announced app between World Liberty and Dolomite. Which was supposed to be developed in collaboration with Aave originally. But I think like 6 or 7 months ago or so, or whenever it was, there was like early inklings of like World Liberty trying to back out of the on-chain governance vote that they had, which essentially said Aave would be like a developer of their lending app, but they went with a competitor at Dolomite. So yeah, Aave's kind of been like the center of a bunch of drama recently with the DAO versus Labs debacle, which has kind of gone quiet for now at least, and then now this. So we'll see what happens.
Well, let's leave it there. Everybody have a safe and happy, exciting week, I think, this week in markets. And we will see you next week for Galaxy Grid. That's all. Have a great one.